What's going on, everyone? This is Robin Invest coming at you with another video. Today I want to talk about portfolio diversification. But before we get to the topic, I'm not a financial advisor. This video is for entertainment and educational purposes, so please do your own due diligence. Guys, if you are interested in building passive income through dividends, please like, share, and subscribe, and let's become financially free together. So again, we are talking about portfolio diversification. So in this video, I am going to go over what true portfolio diversification is to me, and I'm going to talk about ways that you can really diversify your portfolio. So stay tuned and let's get to it. So every investor has heard of portfolio diversification, and a lot of times when we hear portfolio diversification, we hear investing in ETFs or index fund. Now, in index or an ETF, they hold a basket of stocks. Just like, let's take the S&P 500 for an example. The S&P 500 holds 500 companies. So when you invest in the S&P 500, let's say the ETF, let's say SPY, which is the ETF version of the S&P 500. Now, that invests in the 500 largest companies. So when you're putting your money in there, you are part owner of each and every one of those companies. Now, this is why, and I totally get why people say that, because again, when you're putting your money into those basket of stocks, the ETF, again, you own 500 of the largest companies in the world. I mean, not in the world, but in America. But here is the problem with just only investing in the S&P 500. If you truly want to be diversified, every ETF or index fund, they have what's called a top 10 holdings. So the top 10 holdings are the holdings that ETF or index fund holds the most of. So for an example, and I'll talk about the S&P 500. The S&P 500, I don't remember all the top 10 holdings, but it's definitely Google, Amazon, Microsoft, I think Tesla's still there, and Salesforce. I think it was like 5 of those companies, but I'm pretty sure 5 of those companies in there, but I don't remember all 10 of them. But the problem with just only investing in the S&P 500 and calling it diversification is that index fund or ETF has to rely on those top 10 holdings. Now, if those top 10 holdings go up, then great. That whole ETF or index fund is going to go up. But if those top 10 holdings go down, then you're screwed. Because again, when you have an index fund or an ETF that makes up 20, 30, 40, and 50% of the ETF, you solely have to rely on that. I mean, in my opinion, if you're going to just invest in the S&P 500 or any other index, you might as well just hold the top 10 companies as individual stocks. That's in my opinion, though. So it's not true diversification. Now, if they were equal weighted, then yeah, sure. If all the 500 companies were equally weighted, okay, fine, that would be more diversified. But as we see, those top 10 companies in the S&P 500 makes up 30 to 50% of the market cap. Like I would even say the S&P 500, since the tech sector, the AI sector is booming, the S&P 500 is becoming more tech focused. Now, if you're investing in tech, you're going to have more validity. So I think over the years and over the decades, the S&P 500 is going to be more focused on tech, which is going to be more volatile, which means you're going to have we may have bigger returns. But on top of that, we're going to have bigger losses if the market tanks. So who should have a diversified portfolio? People who are a conservative investor and do not want to participate in a whole bunch of volatility. If a person is a retiree, or people who are in retirement, and even beginner investors. And here's some ways to add some diversity to your portfolio. And guys, this is not financial advice. Do your own research, but I'm going to give you some sectors that you need to. So you need to, I would say, number one, pick either the S&P 500 or pick the NASDAQ 100. So you can pick SPY or QQQ. You can pick one of those. Now, if you go for QQQ, that's more tech heavy, so you're going to get more validity, but you're going to get more returns, but you can also experience more losses than the S&P 500. Okay, then invest in the utility sector. So buy a utility ETF, right? Okay, then look for a commodities ETF. And then, let's see, put your money in cash, then put your money in bonds, then put some of that money in bonds. So, when you put your money into different sectors, that definitely smooths out the volatility. So I'll give you some examples as some ETFs for an example. Okay, so let's say your growth sector, let's say I invest in QQQ, right? All right, for the utility sector, I would do XLU, right? For commodities, I would do gold. I would leave a little bit of cash in there, probably 5 to 10%. And this is just what I would do if I really wanted to diversify, right? So cash, I'll probably put some money into some T-bills, to some treasuries. I'm not going to go deep into percentages, so I'm just telling you what some options are good as far as diversification. So if we have a recession, if we have a bear market, if we have a flash crash, then your portfolio is good. Now, I'm not saying that this portfolio, that this type of style is recession proof, because it's not. No stock or index fund or ETF is recession proof. Okay, if one sector goes up, then the other sector is going to go down. Just like, for an example, if the S&P 500 goes down, then gold usually goes up for the most part. So building this portfolio will reduce the volatility, but you can still be at a negative. So like if we had a recession like in 2008, the max drawdown for the S&P 500 was like 55%. Now, the ETFs that I discussed, the max drawdown, like if you invested that in 2008, the max drawdown will be probably 30%. This is just a guess. It will be a lot lower than if you just only invested in the S&P 500 or the Qs. All right, guys, that's all I have for you. If you guys found this video informative and helpful, please like, share, and subscribe. I will see you guys in the next video. Thanks for watching.